is the smart money of equities, the smart money of volatilities as well. Because obviously, if the smart money is buying equities, we know that that's going to be probably bearish the dollar. We know that if the smart money is selling the dollar, we're probably going to be able to buy the Russell on dips. So we could effectively turn this line into a directional bet on equities, couldn't we? Do you see that? That could be a directional bet on equities. So if I'm looking at something like my Russell Dow Jones, which is one of my favored spread trades, because we get really wide separation in terms of what's going on in these ideas, I really need a big discount to make this work. But let's take a look at it anyway. Take a look at the Russell Dow Jones prior to the data here, right? So prior to the data, Russell Dow Jones. Remember, the Russell Dow Jones should run in the same direction as this red line. Okay? You see the opportunity to buy the Russell against the Dow Jones in here? Take the dollar off the trade for a second. Just remove the dollar out of your thoughts here. Can you see the opportunity to sell the Russell Dow Jones up here as a spread? It's pretty good, right? It's a pretty good spreadable buy sell opportunity to sell the spreads. So obviously, if that's the case, this is a pretty good opportunity to buy the spreads here. Well, obviously, if you look at what happened next, well, obviously, the Russell Dow Jones spread annihilated to the top side, right? It absolutely destroyed the top side. So this is a positive correlation. This smart money line is a positive correlation to this line, or so it should be. In most cases, it's true. So when we see just how good some of these spreads can be, then it obviously opens the door to a spread trade storyline that you could perhaps bring to the party. And you see, for example, in here, there was a massive opportunity to buy the Russell Dow Jones spreads in here, wasn't there? Yeah. But where do you buy it? That's what I'm saying. You've got to always have that thing in mind, that there is always going to be other things to take into consideration, not just the dollar. But when these spreads go in the opposite direction, I'm getting very excited about buying the Russell Dow Jones spreads. And when we get the move back to the top side, selling the Russell Dow Jones spreads. When we get back to the bottom edge, buying the Russell Dow Jones spreads. Boom. Now, there's obviously other things we can do. We can look at the smart money on the S&P. Obviously, if the smart money in the S&P is bullish, if the smart money in the VIX is bearish, if the smart money in the Nasdaq's bullish, and if the Nasdaq's leading the S&P and it's bullish, then of course Russell Dow Jones should be an easy buyable opportunity, because that's going to be a sell on the dollar. So we can also add that to the picture, and this is the smart money on the Russell. This is the smart money on equities, S&P, Nasdaq, and volatility. The red line is the volatility, right? So we can obviously recognize that the smart money went incredibly bullish here, didn't it? So the smart money went incredibly bullish equities here. Now, obviously, at that point, we're also seeing the smart money selling dollars. So when we see the smart money selling dollars, we want to be long this Russell. We want to be long this spread here. Now, obviously, the volatility smart money is getting stronger, but it never dominated. And we'd never seen a drop-off in the equities. And that's obviously just because the volatility was rising ahead of the data print, right? So we're not seeing a big sell-off on equities as a result of buying in the volatility markets. What we're seeing is equity staying bullish and the volatility getting higher because of the data release that's coming out. And post the data, you can see the volatility collapses and the equity smart money stays in place, right? So this is things that we can start to build in. The same happened when we were looking at that buy trade over here. You can see the volatility was dropping. The equity was still very strong. I want to buy the Russell here. I want to buy the Russell Dow Jones spreads in here. And that's a very, very easy trade. Well, you can see what happened up here. You can see what happened up here. You can see that the volatility, which was very, very low, you see the equity smart money started to come out hard here, which means I'm probably going to start being able to sell the Russell Dow Jones high prices. And obviously selling the Russell Dow Jones high prices was not a difficult thing to do. We just simply draw a line and we sell into that supply that we've got available. And obviously when the smart money starts to spike higher here on the sell side, this is going to collapse hard, very hard. And it did collapse hard. It collapsed very hard on the Russell Dow Jones. It's an interesting trade, though, isn't it? It's an interesting play because you're trading two markets that aren't quite as volatile, for example, as the NASDAQ might be in terms of that individual spikiness. But it's an incredible spread. If you really want to get into spread trading, it's a story that you're going to look at and go, wow, that really is good as a storyline. You can see, for example, here, you'll see there was a big change in the storyline in here. The sell side drops out and the buy side comes back in. And just at that point, as we drop down into the bottom edges here, you'll see that the smart money actually started to go long equities here. So with the smart money starting to go long equities, you're starting to think about the possibility that there's going to be maybe a spread reversal coming in here that we can maybe take advantage of. Boom, massive profits on the buy side. Crazy good bit of business again, isn't it? Piece by piece, candle by candle, narrative by narrative, it all starts to work out. But it's about choosing how you're going to deal. You know, I particularly love spread trading. I've often said in the past about the room that I've often said in the past in the room that everybody will eventually become a spread trader, and you know, and that's might not be true. You know, a lot of the times it is true. It's a lot of the times people recognize that spread trading is the way that they want to go forward because it's less risky, of course. The oil also had a good buy trade on the bounce, guys. Remember, we'd drawn that target price at the bottom edge for you to look at. Remember fair value? We talked about it, $82. Did anybody remember that? Well, fair value started to improve. Yes? No? Did fair value start to improve off $82 earlier on, before the data came out? Well, we were obviously talking about fair value based on two of our major components. And based on two of our major components, fair value quite clearly improved off the $82 that we told you about earlier. Now, at that stage, you are 5-10 minutes ahead of the data, and you might not fancy taking a shot at oil. You might not fancy it, but it is what it is. You know that you're seeing that selling coming in the dollar. You know that commodities will probably be bullish if that's the case. And you know that oil's not going to be directly impacted by the CPI print. So you're still trading this as a normal marketplace with the possibility of a pop, right? You know, so obviously we got the pop because the dollar moved, and the dollar moved hard. It wasn't oil that popped higher. It was commodities that popped higher. So it's not an oil trade, if you like. It's a commodity play here. And obviously that dollar popping higher gave you a nice opportunity to clear your books at 82.5 again. And since then, of course, the oil price has just reversed out after the gasoline went sell side again here. See it? So when the gasoline went sell side again here and the gasoline went sell side again here, there's the chance of the oil price keep going higher has gone. And we're back to fair value again at the bottom edge. $82 fair value narrative.